So in terms of receivable cycles, primarily the two new verticals, that is the DNB, the interior fit out and built up division, and even the furniture division. The receivable cycles roughly, operates between 90 to 120 days. I mean, ideally we try to conclude a transaction where we can do at 60 days credit terms also, but at the end of it, generally, the way the broad terms in the market works, it kind of spreads between 90 to 120 days. And, if there are certain contracts where even government or semi-government agencies are involved, then, it kind of accordingly stretches further down. Further, secondly, in large contracts, like when we work with clients like TCS and Coforge and all, you have some retention monies which are involved because, they also want to ensure that, once you finish your work, the quality testing and their own internal controls with regards to, the handover of the products, etc., they would like to ensure that even post-completion, there is a certain amount of money which is retained. So that way, the working capital blockage is more in this two segment. With regards to the co-working, our managed office business, we are lucky that in that segment, generally, except for the kind of what monthly gap you have, so it's about 30 days gap. Otherwise, it is pretty much on time, and on an average, all the players, there is no kind of bad debt situation, there is no delay situation. So within 30 days period, we would generally kind of receive every payments from customers who are under the managed office segment.
Got it. The second thing I have is a request. I think all of the business that we conduct are held through the subsidiaries that we have, but I don't see us having published the subsidiary annual report for FY23. So my request is if you can take care to put out the subsidiary annual reports for the last fiscal and FY24 as well.
Yeah, surely. We'll take note of that, and we'll see that if it is not up, we'll definitely put it on the screen.
Thank you.
Thank you. Next question is from the line of Pranav Shrimal from Fins Wealth Advisories. Please go ahead.
Hello. Yeah, I hope I'm audible.
Yes, please.
Yeah. So I wanted to ask, how many seats are we going to add by the end of FY25?
By FY25, we should be closing at around, our target is to close around 65,000 plus seats that we like to achieve by then. So just to give you a bit of trajectory, I mean, as we speak already, by September, we'll be touching around 50 to 55,000 seats, which are already contracted in the sense that, they are already under development or, beginning to get into development. So by September, we'll be touching between 50 to 55. And by March, certainly we'll be crossing 65,000 seats.
And all these seats are they in contract with a particular company like TCS, Q4? These are separate managed.
No, so obviously it will be separate clients. TCS and Coforge are actually our clients for the DNB sector. Okay, actually we work for them on a contractual basis. But our client for the managed office segments are organizations like, Quest Corp, Tech Mahindra Finance, Flipkart, Meta, then you have, Eureka Outsourcing, and many such other large corporates, and Mahindra Finance is also, the Bajaj Finance is also there. So, I mean, the different types of organizations, but broadly, when we say managed office, so we typically focus on established business houses, where, who are in a position to commit you for a certain kind of a lock-in period so that, they have a certainty of their business, and so that we also could derive those certainty for our own businesses as well. And it is very necessary for us to, do a long-term planning, and once we have this kind of customers, it makes, our business model more sustainable.
Completely agree with you, sir. And lastly, what kind of margins can we expect from the TCS Coforge contract? Will they be in line with the current margin?
Yes, they will be. And so I tell you, sir, in DNB division, what happens is that, you have those, so we do develop, design and build for not just for commercial office spaces, but we also do for certain unique, commercial spaces, like we develop R&D centers, we develop, research laboratories, we develop the healthcare centers. So these are those unique developments where we make larger margin compared to, developing an office space, because, when you develop an office space, there are standard costings which everybody is broadly aware about. There are standard products, there are standard category of BOQs and BOMs which are prepared. So in a standard contracts like such, in office spaces development, we probably made between, let's say, around 13 to 15% on a net level. But this increase reasonably well when you go into those specialized contracts of R&D centers and laboratories, etc. And it increases by 5-6% for sure. So average out to, we certainly would be in a position to achieve 15-16% of margins that we are even right now also have targeted this year.
Okay, got it, sir. And lastly, just a question about the seats. So the number of seats we're adding, are we targeting any particular town, or will it be spread across the existing mix?
Yeah, it will be spread across. It's spread across in this major 9 cities, because, these 9 cities are the one which really contributes to broadly to the economy, and they really drive the flex office space market. And we strongly believe that for at least next couple of years, these 9 cities still would continue to hold the spaces.
All right, sir. And one last question. Sir, let's think of almost, EFC as a company in the next 3 to 4 years. Where do we see ourselves? Let's assume the AIF goes smoothly. We have the co-working space. All the segments are picking up. Where do we see ourselves in the next 3 to 5 years?
So, like we mentioned in our opening remarks, and like our MD also very categorically mentioned in the opening remarks, that we want to establish ourselves as an integrated player, where we establish ourselves as real estate as a service provider. We don't want to be purely known as the managed office player only, because, if I want to really create efficiency and deliver the kind of returns that I intend to promise for my shareholders, I need to ensure that I bring the efficiency not just at the capex level but at an operational level, by doing such kind of vertical integrations or horizontal integrations, and kind of expand my horizon to as an holistic player, just then as a single office operators, where my USPs are very limited. But with this verticals added to my kind of arms, I'm really in a position to create a difference in the industry, and that is what we try to achieve in the coming years. In terms of growth, as you specifically questioning for, definitely, as you can appreciate, both this division, the DNB and the furniture manufacturing, they're just new divisions, and they are all going to expound, multifold, because, the base is so small. They will definitely going to contribute substantially to the top line for our company. And also in the managed office players, we definitely see, at least in next couple of years going forward, the market is positive. And as long as the market is really positive on the real estate side, and also the demand from the GCC clients and also the domestic client is on an upswing, we truly believe that we should be, at least if not more, be able to kind of achieve 1.75 times, 0.75 times of growth every year in the total number of seats that we will be keep adding into.
Got it, sir. Thank you. Thank you so much, sir. And wish you all the best, sir.
Thank you so much, please.
Thank you. Next question is from the line of Mustafa Kachwala, an individual investor. Please go ahead.
Hello.
Yes, sir.
Yeah. Congratulations, Umesh, for the success. Sir, I wanted to know what are the top clients and how much % do they contribute?
So as I mentioned, on the managed office side, we have top clients like Quest Corp, we have top clients like Mahindra Finance, we have top clients like Bajaj Finance, Tech Mahindra, Eureka Outsourcing, and many such other players, sir. And all these top clients and many, other large organizations contribute who are contracted with us for a longer tenure. They contribute around 75-80% of our total revenue. And the balance 20% of the total revenue comes from the clients, who are also contracted for not such long period, but at least for a period of about, 12 to 24 months. So depending upon, but I think the majority of the revenue comes from these top clients that we really are contracted with.
Okay. And what are the minimum contract with the top clients?
So generally, sir, minimum locked-in period with top clients are either 3 years and 5-year contract, or some of the special clients with whom we have been, in contract for more than 6, 7, 8 years. Because, as you would appreciate, sir, we are in this industry for more than 10 years now. We have spent a decade, and there are clients who are with us for, such a longer period of time. And with them, we have and they have so much of confidence with us, and we also respect those confidence. And they have always contract with us for a 5-year lock-in period. So we have mix of clients, but generally, like I said, normally any client who joins us, they would come up for a 5-year contract with 3-year lock-in. And then, and the average even lock-in that we also achieve is around 2 to 3 years only.
Okay. So one more question. I was just seeing the OPM. Last quarter, the OPM was 35%, and this quarter, the OPM was 56%. So any reason for this thing?
Oh, no, the reasons are obviously that we have been able to improve upon some of our margins. Like I said, that we are adding these different verticals and, bringing more and more efficiencies. So, the margins are improving, and, the consolidated level margins would improve further. So I think going forward, you will continue to see similar kind of trends.
Okay. So I just one more question. What is the addressable market size for this business segment, and what is the CAGR rate at which the sector market size growing? And what is the market share that we have captured? And how are we targeting on growth?
Okay, so there are multiple questions, sir. I'll try to address how much ever I have kind of understood. Okay. But basically, in terms of the total addressable market, sir, it is, if you look at the total office leasing space market, as our MD said in his opening remark, is more than 800 million square feet of stock available in the top 9 cities. Out of that, the flex office market, has been continuously growing. Earlier they used to occupy not more than 5%, 7% kind of share. And today, it is already kind of occupying 25% of that kind of shares on a ongoing basis. But if you see otherwise, the total stock on a flex office level, it's roughly estimated at about 65 million square feet. And, and then there are about multiple operators. As you can understand, there are various regional players, but there are very limited pan-India players like us who are available in the market. There are players who are, let's say, dominant in a particular city or a particular state. And that is why the number of players are multiple in our industry. In terms of our market share, as you could see, we are, if you consider in the top 5, top 10 players, we are among those top 5, top 10 players in terms of our capacities and in terms of our presence. And most importantly, in terms of the profitability, probably we are one of the top 3 players. Or I don't want to really sound too optimistic, but yes, what going forward we see the trend that would be capturing a reasonable percentage of the total market share, and there is a lot of growth opportunities still available, sir.
Okay. And what are the percentage we are targeting in next 3 years?
Percentage of what, sir?
Percentage of growth
Yeah, so percentage of growth industry level, as they say that this particular flex office industry is going at a CAGR of about 20%. It's been ranging pre-COVID between, let's say, around 18 to 22%, while, post-COVID it is between 22 plus. So on an average, it is around 20% plus of CAGR. So we would definitely all would be, working at the industry. We would definitely like to beat the industry growth rate and achieve much larger growth rate, which you can see in our results also. And we would like to continue to achieve similar kind of, as I have explained in my previous question, that at least we would definitely be increasing our seat base, from year-on-year basis with 75% growth rate at least in the seat capacity. So, sir, do we have any direct listed players, our competitor, I mean to say? So, sir, in our industry, a lot of players have different business models. There are different players with different business models. Yes, all of us are, in managed office business or co-working businesses, as they commonly say. But the business models differ quite substantially. But if you want to look at in terms of, the nearest competitors for us is obviously AWFI's office, which has just got listed themselves.
Got listed on them. Yeah,
their business model is relatively a bit different, but like I said, they are also from the same industry, and we also belong to the same industry. But like I said, that's the kind of comparison we can draw at the most. There are no other listed players to our best of our knowledge.
I think Contour Space is also in the similar line.
Sorry to interrupt, Mr. Kachwala. May we please request you to rejoin the queue?
Yes, they are also in the...
waiting for their...
Okay, no issues. Thanks a lot, sir.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please restrict your questions to 2 questions per participant. If you have any follow-up questions, please rejoin the queue. Next question is from the line of Nitin Devaria from Prithvi Finmart. Please go ahead.
Hello. Thank you for the opportunity, sir. As you mentioned in the opening remarks that our seat capacity has reached to 43,000 capacity right now. I just wanted to first understand what is our occupancy level for the Q4 FY24 and also for the full year.
Q4 FY24
and also for the full year FY24.
So Q4 FY24 we were more than 90%, and full year basis also I think at about 88 to 90%. That would be the kind of range. Because generally on an average we are always 90 plus kind of occupancy. That is what we maintain. Which largely comes from the fact that, most of our clientele, 75 to 80% of the revenue is contributed from the long-term clients.
And sir, just to understand the business dynamic front, what is our capex cost per seat like?
Sorry to interrupt, Mr. Nitin, your voice is...
Am I audible now?
Yes.
Thank you. Sir, I just wanted to understand what is our capex cost per seat?
So capex cost per seat for us is around 50,000 rupees. That's what we kind of estimate internally, and that's what the target we really have.
Okay. Sir, to my understanding, I guess our capex cost per seat is relatively much lower than that of other listed players. So, what are the reasons for the same? Is there anything like they might be spending more on the interior fit-out front or on the facility as compared to us? Or what is that mode that we have?
So, we obviously, number one, obviously that we have a large, huge purchasing capability, and that is where we do quite a bit of, sourcing is one of the key factors when it comes to, maintaining your cost on a substantially lower level. Second important thing is, that over 10 years, we have been doing this and kind of developing our own centers without use of any, external third party, contractors or advisors. So what has happened is that, in the process we have developed so different efficiency levels that at different level, whether it is fitting out a particular HVAC system or whether it is, creating an internet connectivity system for the entire center, the kind of efficiency that we have achieved, that has been able to that is enabling us to kind of bring the overall cost to a level that we are able to maintain that efficiency. And I think that is the reason precisely why we have gone into creating these additional divisions of D&B, and also our sourcing, improving our sourcing ability with getting into the furniture manufacturing. So I think these are results of 10 odd years of hard work, 10 odd years of dedicated commitment to bringing down the cost, bringing up the efficiency, and I think that is all paying up well to us right now in maintaining this cost levels.
Okay. And sir, one more question if I may. Sir, as I have noted, like this year we have reached around 43,000 seats, and last year we were somewhere around 25,000 seats. So how have we added new seats to the same facilities, or have we added entered new cities? How has that grown? Hello. Am I audible, sir?
Your voice is cracking through. Hello.
Am I audible now, sir?
Not yet. Mr. Moderator, could you listen to the participant properly, please?
Hello. Am I audible now?
Management line is clear, sir. And Mr. Nitin line is also clear. We can hear him clearly.
Sir, may I proceed with the question?
Yes, please go ahead, Mr. Nitin.
So, sir, my question was, like last year we were somewhere around 23,000 seats, and this year we are around 40. We have closed FY24 at 43,000 seats. So I just wanted to understand, like, how has this increased? Like, have we added new seats in the same facilities, or have we entered new geography?
Actually, there is some issue with the line. Please allow us a minute.
I'll join back.
Disconnect and reconnect.
Yes, I'll join back.
Ladies and gentlemen, please stay connected while we reconnect the management to the conference call.
We place on hold until the chairperson arrives.
Ladies and gentlemen, thank you for patiently holding. We have the management line reconnected. So we will move on to the next question from the line of Harsh Mulchandani from Chris PMS. Please proceed.
Thank you for the opportunity. Congratulations to team for a great set of numbers. I had a couple of questions. One was, I want to understand what is the current ALM split which we have. One is on the contracts which we have with the landlords. What is the weighted average duration of those contracts? And for the managed office lease, what is the average duration with the existing clients which we have on board?
Yes. So with regards to the average client contracts with the landlords are concerned, it depends only, this differentiates a bit between the state of Maharashtra and the rest of India, because in state of Maharashtra, if we sign a contract with a landlord for more than 5 years, then it gets converted into, a lease contract, and we kind of end up paying a large stamp duty on that, almost equivalent to the amount that we need to pay on a transfer of property. So generally in Maharashtra, all our agreements are on a 5-year contract with the landlord. Obviously, like I said, that we are in this industry for more than 10 years, and we started for Maharashtra, and we have been able to successfully renew the agreements for another term of 5 years, and so again accordingly in the state of Maharashtra. Otherwise, from there, the state of Maharashtra, our average contracts range between 7 to 9 years with the landlord. With regards to our contracts with our customers, as we said, that all our enterprise, all our large customers, we generally have a contract period of 5 years with lock-in period of 3 years or 5 years, depending upon the comfort that we have with the customer. That is the kind of average that we generally maintain.
Got it. Fair enough. And one question I had with respect to the investor presentation. In one of the slides, you have mentioned capacity under development, and then you have mentioned seats under development. So just wanted to understand what is the difference in your terms when you say capacity under development was close to 40,000 seats and seats under development was close to 4,000 numbers. So what do you exactly want to convey in that slide? So
I'll explain to you. What happens, sir, in our industry, these are very loosely used terms, and that is why we try to be very specific here. So if you look at that slide, there are about 5 different parameters that are mentioned. Capacity under development is the capacity which are already contracted and where either the seats are under development, means seats are getting made right now. Okay, the interior in some of the centers are still under development. Capacity operational is a capacity which is fully ready and already operational. So those centers are operational and working. There is no development going on. Okay. And the billed seats are the seats which I'm billing to my customers right now, and where I'm generating my revenue already. And the seats under development is a difference between the capacity operational and the capacity under development. So, what is my operating capacity and what is the developmental capacity? So the development capacity will come in line in, let's say, in a month or so, while operational capacity is already operating while we are sitting on that particular day. So I think that's the difference. And the inventory is the difference between the operational capacity and the bill seat. You got me?
Got it. So the first number is basically the bigger, is the correct number to look at if you want to see what number would be operational in the short term.
Yes, absolutely.
Got it. And just one last question is, we are working on multiple segments. So going forward, how would the revenue split look, say, from the managed office spaces, the furniture segment, and then probably we would have some managed asset income from the REITs, etc., which would probably come. So maybe 2-3 years down the line, where would how would the revenue split look?
So going forward, yes, the revenue from the managed office business would comparatively go down in terms of